Thank you all for joining us. My name is Bill Harrington with Advantage Futures, and I want to thank you for coming to this this edition of our seminar series, 2010 seminar series. Today we have Fred Sturm with us from the CME Group. Fred is going to walk us through some of the intricacies and methods for trading the TED spread. I think it's a trade that has gained some recent interest. It's been a little volatile the last couple of weeks. It had been quiet for quite some time. I think this seminar is very timely, and Fred is quite a bit of experience with this market, and I think he'll share with us probably 30-45 minutes of discussion, and then we'll have 15 minutes or so of question and answer. So thank you, Fred, for joining us. Thank you all for coming.
Bill, that was kind. Thank you so much. So I'm Fred. I'm with the research and product development area of the exchange, and everything is just as Bill Harrington said. We're here to talk about term TED spreads. And I'm going to try to do this in 4 pieces. It's like, well, why would we bother talking about this right now? There are good reasons. We'll establish a little bit of nomenclature. We'll spend a fair amount of time talking about just where you park yourself on the euro-dollar strip to structure the trade. The way this is done has changed a lot over the years, so it's actually, this is worth talking about in detail. And then finally, if you're going to put one of these things on, especially if you're trading opportunistically, you need to be able to monitor the trade's performance. So we're going to say a few things about that, and then if I haven't bored you to tears, there'll be plenty of time for questions. So let's just get started. Why would I be coming here pestering you with this conversation today? It's exactly as Bill Harrington said. Volatility has picked up in the TED spread after a spell of a year and a half of quietude. This 7-year history, that sounds biblical, doesn't it? The 7-year history is kind of telling. Up until mid-2007, this was a very good trade. It was ideal for an opportunistic trader. There was enough volatility in it to make your living without there being so much volatility that it was going to turn around and bite you or kill you. Between 2007 and the end of 2008, you all are a smart audience, so I'm not going to belabor the point. But there's good volatility and bad volatility. Bad volatility is deep, structural, institutional, earthquake kind of stuff. And that's mostly what we saw between 2007 and early 2009. That is the last place on earth that an opportunistic trader wants to be, because that's precisely the sort of environment in which an opportunistic trader can be steamrollered by things he knows not what. You're not here to be, cat chow. You're here to make a living. A plot of moving standard deviations just clarifies what I said. You want more volatility, but you want volatility in a good way. And, all of the rumpus between mid-2007 and early 2009 sticks out like a sore thumb. That's fatal. But just lately, there's been this nice, comparatively orderly increase in TED spread volatility. And it bears a comforting family resemblance to what had prevailed prior to mid-07. So this is a trade worth looking at again. Let's get a few definitions in order. The TED is nothing but, Treasury exposure of some sort spread against euro-dollar exposure of some sort. If you're long the TED, you're assumed to be long the Treasury leg and short the euro-dollar leg, and vice versa. The Treasury leg can be whatever you want it to be. Typically, it's the on-the-run note, 2-year or 5-year, for example. If you're using futures, There are good reasons for why that might be increasingly popular and increasingly alluring, especially for an opportunistic trader. You'd be using the front future. The euro-dollar leg can be whatever you want. I'm going to discuss that in greater detail in a few minutes. 15 years ago, somebody would have punched me or laughed me off the stage, or both, for having said something like that. But things are different. The one rule that's really important is that the DV01 exposure on both sides of the leg should be equal. That's really all the discipline you need to impose upon this. The rest of it is a matter of speculative traders' creativity. Where do you see the opportunity? You can pick, let's assume you've got some Treasury exposure, an on-the-run 2-year note in hand, or you've decided that's going to be the Treasury leg of whatever you're doing. You can choose the euro-dollar leg in lots of different ways. You could say, look, here is the point on the euro-dollar strip that is most liquid, or that has the deepest volume quoted at best bid and best offer. And you can choose your spot on the euro-dollar strip using a criterion like this. An alternative, for people who have known me a lot of years, you've seen this picture a lot over the years, you can choose on the basis of correlation. And that's sensible. For a lot of purposes, you might want a euro-dollar futures contract that correlates highly with your Treasury note or Treasury futures contract. You don't want the correlation to be perfect, because that would mean by definition that there's no trading opportunity. But, as long as there's a little bit of grit in the machine, that's your opportunity. Shopping in terms of correlation allows you to select, just how much decorrelation you're willing to tolerate, how much your trading desk risk management system is willing to tolerate. So here we are. Over the last 7 years, this is kind of what the correlation profile with the on-the-run 2-year and the front 2-year would have looked like. You'll notice that there's nearly no difference at all. Ditto for the 5-year. Here again, this is the on-the-run 5-year, front 5-year future, correlated with each of the first 20 euro-dollar futures. Suppose your criterion is simply to pick out whatever is most tightly correlated. And that might be part of your discipline, and then you trade whatever residual opportunity arises between the Treasury leg and the euro-dollar leg. You'd come up with a summary like this. This simply captures what you just saw. Over the last 7 years, the first red euro-dollar future is what correlates most tightly, both with the on-the-run 2-year and with the front 2-year future. The first green happens to do the trick for both the on-the-run 5-year and the front future. If it's packs that interest you, well, golly, no surprise. You'd go for a red pack if you're spreading off against a 2-year note. You'd go for a green pack if you're spreading off against a 5-year note. I've shown correlations for bundles as well. There might be reasons for why you want to spread off against that. The long run is wonderful. It's a good thing to have in your mind's eye, but you always want to check the short run. If life is nothing but a series of short runs, here's where we are. So, the least you can do for yourself is just to check to see that whatever's going on lately comports with what the long run looks like. So, for the last 3 months, mid-Feb to mid-May, here again, just correlations of daily changes in these things. What do you see? It's kind of comforting. Euro-dollar futures price dynamics still correlate very highly with Treasury price dynamics. If maximum correlation is kind of the rule of thumb you're using in choosing which euro-dollar future you're going to employ in making the spread, well, you know, lately third red instead of first red might be preferable. The second green might be preferred to the first green. There's no rule that says you have to choose one or the other. So, you know, this is where if you're going to flip coins, check to see what the liquidity is. Check to see how easy it is for you to get in or get out of these things. The nice thing about this is that it might warn you off. Look at what's happened with the 2-year bundle. That has decorrelated pretty severely against 2-year Treasury exposure. That's either a trading opportunity for you or it's something you want to avoid. Either way, you want to be aware of it. A picture is always better than my 1,000 words. So, you know, here's another good picture to keep in your mind's eye. Now, this is nothing but, you know, rolling 3-month correlations. And what I've done is to zero in on the first red contract for the 2-year and the red pack. For the 5-year, I've done the 5-year bundle in the first green. All this stuff that happened at the end of 2008 and 2009 is obvious. That's an environment you want to avoid for this sort of trade, but you knew that. What's interesting to me is that, here, if you look back at the middle of 2003, those of you with long memories will recall there was a monumental revaluation of the back end of the yield curve in the late summer of 2003. And it is interesting to me that this caused the correlative relationship to shift around, I mean, quite a bit in the case of the 2-year, but, you know, noticeably in the case of the 5-year. So if you're going to go shopping, just take a good, well-informed grocery list with you. That's kind of the point. Once you've picked the euro-dollar contract or the euro-dollar pack or the bundle that you're going to use to implement the trade, the rest of this is simple. Remember the rule. Just make sure that the DV01s are the same on both legs. Here's an example from the close, 15th of April. For the June 2-year future, DV01, the futures DV01 was $36.50 per contract. For 100 million notional, a 500 lot, it's $18,250. What's the DV01 for a euro-dollar future? $25. Divide that through and bingo, you get 730 euro-dollars that you'd need to bump up against 500 2-year futures. And that can be 730 of your favorite euro-dollar future, the expiry of your choice. It could be 182 or 183 of the red pack, or, you know, another pack of your choice. But it has to total out to 730 contracts. Same line of reasoning applies to the 5-year. I just got that there to satisfy your curiosity. Okay, I am old. This is the point at which I get to digress a little bit. What I have just described is not the way things used to be. 15 years ago, this would have looked laughable, but for a few practitioners. Incidentally, this is a good opportunity for me to give some credit where credit is due. Bill Harrington and Kurt Palumpus are both in the audience, and I had the pleasure of working closely with them many years ago. We all worked for a team under Joe Guinan, under a different banner than now. We're working under different banners now, but I learned volumes about just sort of the common sense of these sorts of trades from those guys. So I'm indebted to you. What did people used to do? In essence, they would take the euro-dollar futures strip, more specifically, the forward rates embedded in those euro-dollar futures contract prices, and construct a family of LIBOR discount factors. Because this thing stretches out to 10 years, I mean, in theory, you've got this wonderful term structured discount factors that reaches out a decade. People who are really, really clever would apply a non-convexity bias. I think we're all aware what a euro-dollar futures contract rate is not, strictly speaking, a forward rate. And if you pretend it is, for the nearby future, you won't hurt yourself. If you're talking about a future that expires 4, 5, 8 years out, you're way off. So the outcome of an exercise like this would be a bunch of discount factors, and what folks would do then was pick out some Treasury note of interest. Let's pretend it's the on-the-run 2-year note as of 15th of April, and they would interpolate from this family of discount factors that they've constructed, the discount factors that would apply on the Treasury notes cash flow payment dates. Once you've got that, a bunch of things fall into place. You can compute the present discounted value in LIBOR terms of the Treasury notes cash flows. What, in essence, you've done is to turn your Treasury note into a synthetic euro bond. In the case of this Treasury note, the ones of March 12, the yield to maturity that pops out is 1.157% per annum. The Treasury ones of March 12 were in fact yielding 1.024, so bingo, there's a 2-year TED spread in yield terms, 13.3 bips. Now, does that give you a TED spread that actually has some legitimate meaning as such? I mean, this is a real honest-to-God synthetic euro bond bumped up against a Treasury note with exactly the same cash flows. So this yield spread has a very, very clear interpretation. You could also do perturb the forward rates in that forward rate curve that you'd extracted from the euro-dollar strip to get hedge ratios. So for example, if I were going to create a synthetic euro bond for 100 million face value of the ones of March 12, here is what my hedge ratio would look like. Interesting creature, isn't it? Look at how that compares with the other things I've been talking about. 775 euro-dollar futures is essentially the DV01 for 100 million face value of this note. I don't have to do this many of each of these 8 futures. I can just slam on 775 of a contract of my choice. That might be the first red. I can do a red pack. Boils down to 194 of each. I can do a bundle if I want. If you want to be charitable, you could describe each of these as an approximation to this. But they really aren't. They're different. This has not been popular for a long time, this approach. It's not to say that it won't regain popularity, but it has not been popular for a long time. This sort of empirical, quick and dirty approach has risen in popularity, though, and to the extent that TED trading is still around and still active, that's more or less how it's done. What happened? What changed? The customers who showed up at the doors of futures commission merchants initially asking for this sort of trade were people who were going to get married to their positions. They tended to be swap desks who were either receiving or paying fixed, and they knew they were going to be in this way for a long time, and they wanted to have something on for a long time that would neutralize that risk. So they were willing to go through the trouble of having a broker put on a hedge ratio, just so, and then maintain that, tweak it, adjust it day by day or week by week as yield levels or the pitch of the yield curve changed. So strategically oriented market participants love this. Its great virtue is that there is this TED spread that is really legitimate. I mean, that 13.3 bips I pointed to earlier actually has good, solid analytical underpinnings. The problem with this approach is that it was just a pain in the neck to enter and to exit. It took a lot of babysitting. And that might be exactly the right hedge ratio, that weird combination of the first 8 Eurodollar futures I showed you. And that might be exactly the right thing to do on the 15th of April of 2010. You know, a week or 2 months later, you might find you have to adjust the thing all to hell and gone. So it required a lot of babysitting. These quick and dirty TED spreads in the meantime were pioneered by another whole bunch of users. And, you know, it's my recollection that it was mostly government securities desks. Sometimes swap desks. But if you have people who have like inventory management problems, they don't want to get married to some, you know, highly crafted, labor-intensive hedge position that has a lot of entry and exit risk. All they want is something that's going to work for a day, hell, even a few hours. So a 2-year note trader at a dealership or at a very active fund would call the broking desk and say, okay, I'd like to lay off this 2-year note exposure. Don't belabor me with a bunch of, you know, weird combinations. Just give me something quick. Give me a stack, give me a pack. All I need to be able to do is get in and get out quickly. So it was speed and tractability and, you know, guess what? Liquidity that won the day. This comes at the cost of there being no bond yield that is easily interpretable as the spread between a Treasury note and a synthetic euro bond. But if you're a tactical opportunistic trader, so what? It's not a big price, really. So let's say a few things about how you manage a position like this. And let's suppose, just for the sake of argument, the examples I'm going to show you in the next few slides are just Eurodollar futures spread off against Treasury futures. You'll see why momentarily. You can look at this the way you might look at other futures spreads, just one price minus another. I don't recommend that. I really don't. A Eurodollar futures price is really nothing but a forward money market interest rate, and a Treasury futures price is a forward asset price. And this is oil and water. These things really don't mix. To put this more precisely, you can look at, you can compute that spread, but how you interpret it is going to be a world of difficulty and quite possibly a world of pain for you. With a little bit of effort, it pays to translate all of this into interest rate spread terms. It's not that difficult to compute. I'll show you in a second. It gives you a good, I think, understandable way of monitoring how the position is behaving for you during the day. And by the way, it's not that difficult to interpret. It's just a forward LIBOR rate as reflected in the, approximately, in the Eurodollar future minus some Treasury yield. The beauty of this is you know what the DV01 is on your trade. So every one of these spread bips is just that DV01. This is a nice, tidy way for you to be able to see during a trading session whether a position's doing what you want it to do, whether it's reached your pain threshold, whether it's behaving beyond your wildest expectations. This is exactly what you might need to make a quick decision about whether to, add to a trade or close it out. So if you're going to implement an interest rate spread monitoring mechanism, if the Treasury leg of your trade is a cash note, I think you all have the ability to do that if you want. Well, this is easy. The Treasury note does have a yield. It's a legitimate yield to maturity. Just bump that up against the money market rate that's reflected in your Eurodollar futures structure. Whether it's the contract rate or the PAC average rate, doesn't make any difference. That's a money market rate. If the Treasury leg is a futures contract, there are various ways you can get to this yield spread. The Eurodollar leg is, remains the easy part. But what's probably fastest would be to back out the forward yield on the cheapest to deliver Treasury note that's implied by the Treasury futures price. It's not hard to do. Here again, let's go back to 15th of April. You paid taxes on the 15th of April, but this is a nice reminder. You can still make money on the 15th of April. What I'm going to do is look at a couple of examples. June 10 2-year contract and the June 10 5-year contract. So just remember, I'm going to insult your intelligence by belaboring the obvious. What is the TED spread? Nothing but the ED rate minus the Treasury yield. For this purpose, what is the Treasury yield? What you're going to do is take the futures price, multiply it by the cheapest to deliver conversion factor, add a basis guesstimate. That gets you the forward price of the cheapest to deliver issue, and you can compute the forward yield. You can take all this, you can put a price feed into an Excel spreadsheet and do this. This is really kind of easy stuff. Where does this basis guesstimate come from? You can be as clever about this or as sophisticated as you want. In the following example I'm going to show you, it's nothing more than the cheapest to deliver basis. This is in futures terms and not cash note terms. It's the cheapest to deliver basis from the previous night's close. You use this mechanism and you look at that. that becomes a fixed value. I mean, it's just something you posit. This you know because the exchange tells you what the conversion factor is. All you need to do is plug in the futures price and then compute the yield to maturity. Those of you who are familiar with the futures basis, you'll know that if there's more than one Treasury issue jockeying for cheap to deliver status, you might want to think twice about using futures at all, or you might want to take a more sophisticated crack at this. If the basis is volatile, it isn't lately, but if the basis ever gets volatile, whatever guesstimate you plug in from the night before or from the morning of is something you want to be looking at during the day. These are not things you have to worry about right here, right now. Not in this yield environment, but they might. That basis value, all that this table does is get you to what that basis guesstimate is. In the case of the 2-year note, it's 1/4 of a 32. In the case of the 5-year note, at the close on 15 of April, it's about 1 2/3 30 seconds. That's that little constant term you're going to add in. I could force march you through all the steps, but I won't. I think you are a smart bunch of guys. If somebody wants to talk about how I got that, or what I was assuming, or what abuses I was making, we'll talk afterwards. But let's keep going for the time being. So you've got most of what you need. What's the size of the trade? Let's assume that you're going to do 100 million of the Treasury leg, and that's kind of a big number, but I like it because I don't have to round a lot. 100 million of the 2-year, 100 million notional of the 5-year. Okay, the DV01 per 2-year futures contract would be 36.50. For a 500 lot, 18,250. Divide that by 25. If you're buying this, you're going to be buying a 500 lot of June 2 years, and you're going to be selling 730 of, let's say, the first red, the June 11 contract. Same arithmetic for trade setup would apply to the 5-year. Just get the futures DV01, divide by 25, bingo. Pick your spot. In this case, we're going to use the first green. This just summarizes the arithmetic. If you want to watch this yield spread throughout the day, throughout the trading session, fine. Just set up this price. That's the only variable. Everything else you know. Be ready to compute a Treasury yield to maturity from that price for the right forward date. And you're rocking and rolling. How does it look? This is so tedious. A picture is so much better. It really is. There. There. Here's the 2-year, here's the 5-year TED, left and right respectively. And these are 5-minute snapshots from Globex for the June 11 Eurodollar, the June of 12 Eurodollar, and then for these implied forward yields computed as I just said. So that's an okay picture, but this is so much more fun. Okay. You don't have to do a 5-minute sample. You can make this as dense as you want. If you're doing algorithmic trading, you need this to be robust enough to work in real time. But this framework is simple enough and flexible enough to lend itself to that. And this is just to say that you know, maybe these TED spreads started off as kind of strategic trades. I'm going to put this on, and gee, I think over the next 3 months or 6 months, thus and so is going to happen to the spread between Treasury yields and Eurobond yields. But there's plenty of room for an opportunistic trader. There's plenty of room, indeed, for day trading these things. Check it out. On this particular Friday, April the 16th, there was actually a trend during the day, something you might have been able to take advantage of, but there was plenty of wobble around the trend. You know, if you remember that each of these basis points is worth, you know, a little over 18,000. Okay, this isn't so bad. It's not getting away from you, but it's volatile enough for you to be able to take out a bit here or there. I mean, on this particular day, the 5-year looks like a more interesting source of profit opportunity, but that's only after the fact. Look at that. I'm all done. I'm all done. This is a good book, given everything I've just said. I mean, most of you probably own it, or you've seen it. In 2003, this was bang up to date. There are whole chapters that don't have a speck of dust on them, but one thing that Galen and his collaborators did not address was like the needs of tactical or high-frequency traders. So that, you know, some of what I've said would not show up here, but, you know, even if you're trading opportunistically, it doesn't hurt to know the basics. The basics are what could kill you. Now, you all been nice. Are there any questions? Okay, while you're thinking of it, you don't have to have any questions. You can walk away. I need to make an advertisement. We're having an excellent, we being the exchange, are sponsoring a seminar on Treasury futures, Tuesday afternoon, 3 p.m. Our colleague Jonathan Kronstein is featured. He's a good speaker.
It's going to be here?
This will be, thank you for asking, Auditorium 20 South Wacker. For those of you who trade either standard bond futures or ultra bond futures, there will be some interesting announcements.
Is this next Tuesday?
Yes, sir. So I wanted to get that plug in. That's worth coming out for. But you guys are always fun to talk to, even if you don't have any questions. Grab a cookie, and I'll see you later.
Thank you. Thank you, Fred. Thank you all for coming. The material that was presented here we do have available electronically, so if you just check at the desk where you checked in, make sure they have your email address and let us know that you'd like it. We can get it emailed to you today. And the whole presentation will also be on our website at advantagefutures.com probably in the next week or two, so you can review it if there's something you missed. And I think Fred would also be willing to field any phone calls, as would any of us at Advantage, if you have questions about this or anything else we can do for you.